Welcome to Fuqua LinkedIn Live. My name is Xu Jiang, accounting professor at the Fuqua School of Business. My research interests are generally related to economic consequences of certain reporting and financial accounting standards. In general, I'm interested in regulation. Today, I'm talking about how standards that make insider trading more transparent also make insider trading more or less profitable. So to discuss this question in more detail, let's look at the slides. So this work is a joint work by Xiuming Martin, who is a professor from Washington University in St. Louis, and one of our talented PhD students in accounting, Benda. He is graduating this year and he will join Hong Kong UST as an assistant professor of accounting. So before we go into the question we're studying in this paper, let me first provide some background information. We know that insiders, they naturally have more private information about the firm they're working for. And therefore, they have an incentive to trade on their private information. Imagine you're an executive at a pharmaceutical firm. You know about the details of the clinical trials of your products. And you know whether the trial results are good or bad before the market knows. And so you have incentive to trade before the market knows about the information and see if you can make profits on it. Security regulators, of course, is going to prohibit such insider trading behavior that are based on material non-public information. So in the previous example, even if you know the results of the clinical trial in advance, you cannot trade on it before the whole market knows about it. Proving based on, however, is very hard because you need to show that the trading is really related to the information. Therefore, the SEC comes out with a new solution. So it comes out with a new regulation requiring insiders to report their trades on a more timely basis. Previously, they can report within 10 days of the end of the trading month. So for example, if I'm an insider, I make a trade today, I do not need to report until July the 10th. So it may become too late. The new regulation says that you have to report your trades within 2 business days after trading. So it greatly accelerates the timeliness of the report of insider trades. And the intention of SEC is by providing more timely reporting of insider trading, insiders' information advantage can be eroded. So in the previous example, if I have some information today and I trade, you won't know about such information until the 10th of next month. But now you're going to know about that within 2 business days after my trading. So in this case, the regulator hopes that the trading profits is going to be reduced because the insider's information advantage is reduced. Therefore, insiders may have less tendency to trade on such information. So this is our research question. We're studying whether this regulation, which accelerates insider transaction, increase or decrease the profit of insider trading. The short answer is that we find this regulation actually increases insider trading profit by facilitating insider coordination. You may think, why this could happen, and you may have questions about this. We're going to have a Q&A session at the end of the presentation, but feel free to write out your questions for now. So what does insider coordination mean? Well, one analogy to think about insider coordination, you can think about examples of cartels. One famous cartel is the Organization of the Petroleum Exporting Countries, or OPEC, which used to have a very important role in determining the price of the crude oil. And so the logic of the cartels works as follows. So if each member of OPEC, they compete separately on the markets, they will have a tendency to produce more. That results in a more competitive crude oil market, lower prices and lower profit for each member. You can always do better. How can you do better? You form a cartel. And the cartel is going to decide how much each producer, each member can produce in terms of the number of barrels of crude oil. So if each member is going to produce less, then you can achieve higher price. And therefore, you can achieve higher profit for everybody because the increased price more than compensates for the reduction in production quantity. Essentially, the cartel operates more like a monopoly. We know that monopoly earns higher profits than perfectly competitive firms. The key issue with this arrangement is everybody in the cartel has an incentive to produce more. Because if I produce a little bit more, it would not really move price that much, but it's going to generate a higher profit for me because I'm producing more. And if everybody thinks like that, then everybody is going to produce more. And the result is still a lower profit for everybody. To prevent overproducing, the cartel needs to set up a penalty mechanism or penalizing mechanism to make sure that each member has no incentive to overproduce. How do they do that? Here's the mechanism. If, let's say, in this year you're going to deviate, let's say you can only produce 100,000 barrels per month, and you're producing, let's say, 150,000 barrels per month, then the mechanism is that everybody is going to produce more in the future, which means that if you're deviating in this year, you generate more current profits, then everybody else is going to penalize you. So in the future, your expected profit is going to be low. And so in this case, you're not going to deviate. You're just going to produce based on whatever the cartel asks you to do. Of course, this mechanism depends crucially on the cartel is able to observe each member's output. If you cannot observe each member's output, then there is no way you know that whether they're deviating or not. So you cannot implement the penalization mechanism. So in other words, the transparency of each member's action producing oil, in this case, facilitates the coordination and thus collusion of the cartel. So we use this analogy to the insider trading setting. We actually have an economic model illustrating the intuition. But applying to the insider trading setting, what we show is if you make insider trading more timely, each insider can observe their trading on a more timely manner. And so they are more able to implement the penalization mechanism as we stated above. And so in this case, they're more likely to coordinate and collude. And of course, they're going to coordinate and collude implicitly because any explicit coordination is prohibited by law. So based on this theoretical logic, here are our predictions. We're saying if you require more timely reporting of insider trading, that's going to facilitate better insider coordination, which results in higher insider trading profit. And of course, how much higher insider trading profit depends on the characteristics of firms. We argue that if firms' characteristics are such that the coordination is more likely to succeed, then the increase in insider trading profit is going to be higher. And they're more likely to succeed if insiders have tighter social connections, which is reflected in, for example, insiders going to the same school, they work in the same company before, etc. Also, they're more likely to succeed if insider trades are reported with less lag. If insider traders are reported with more lag, then it's very hard to monitor whether insider trades follow the rules. And so the coordination is less likely to succeed. And we test our prediction using the following empirical setting. We know that there is a law which requires accelerated reporting of insider trades in 2002. The exact date is August 29, 2002. It's part of the Sarbanes-Oxley Act that you may have heard about. And so we look at trades by insiders, which are corporate executives and officers, around the 2002 when the law is implemented, from 1997 to 2006. And we compare the changes in trading profits of insiders around this rule change. So basically, we look at 1997 to 2001 insider trading profits. We compare that with 2003 to 2006 insider trading profits. We're going to see whether the trading profits increase or not. We remove firms in the financial and utilities industries this is a common practice in this kind of research because financials and utilities firms, they're heavily regulated. And so they face different regulatory requirements. And so they may have distinct business models. So this thing may not work. And here are our results. The first thing, perhaps surprising to you, is that average insider trading actually is not profitable. It generates a loss of about $20,000 per year. And this is not really surprising to us as researchers on insider trading, because a lot of insider trades, insiders have to specify, we have to buy or sell certain amounts of shares in certain months of the year. So independent of information, only certain trades, they're information based. So it's not surprising that those trades generate a loss. However, we see that after more timely reporting, the insider trading profit in terms of returns increases by about 0.7% per day. What is the economic significance of this result? The economic significance is that the insider trading profits increases by about 111,000 per year. And so compared with the original loss of 20,000, this on average shifts insider trading into more profits. I want to emphasize this is abnormal trading profit. By abnormal, we means, for example, if the market is increasing return, then of course insider trading is going to be profitable. But you have to subtract the market return from it. And also, insiders with social connections, they see their abnormal trading profits increases by 0.05% per day, which translates into the increase in trading profit of about $80,000 per year. So insiders with social connections, they're doing even better. Insiders with delayed reporting. So the regulation says that you have to report insider trades within 2 business days, but not all firms comply with that. And some firms, they may report early, some firms, they may report late. For insiders, in firms that's reporting late, the trading profit decreases by about 0.018% per day. And that results in a decrease of average trading profit of about 28,000 per year. So those are the magnitudes. So what you can see is the magnitude is not particularly large. But remember, we're looking at a sample of every firm, including small firms. For firms that are larger, for example, in S&P 500, this would be much larger. So to conclude, we empirically show using data that accelerated reporting of insider trades increase insiders' trading profits. And the underlying theoretical channel, as we argue, is through improved coordination or collusion in trading, just like how cartels like the OPEC works. And here are some policy implications. So first implication is accelerated insider trading increases the information content of insider trading, which is true because insider trading now is more informative about the information that the insiders may have. However, we show that such increased information content may not reduce insider trading. On the contrary, it actually improves insiders' trading profit and actually increases their incentive to trade. So we're arguing there is an unintended consequence of this regulation, and the standard setters may need to think twice about how to implement insider trading regulations. So this is the end of the presentation. Thank you very much for listening. Let me see if there is any questions. The first question is, again, it's related to the policy implications. What can the regulators, what can the SEC do about it? Well, in our case, we show that accelerating reporting of insider trading does not work. So perhaps what the regulators can do is to monitor more intensively insider trading instead of relying on just accelerated reporting. In addition, what the regulator can do is try to impose insiders to trading on a fixed window. So they're just saying, for example, you only trade shares in the first week of February or in the first week of May, etc. In this case, it can minimize the tendency for insiders to trade on information. So that's the first question. The second question, asks about whether or not we have implications for financial firms, for banks. Well, in our sample, we don't have banks or financial firms. And the reason is they're heavily regulated. And because they're heavily regulated, our conjecture is insider trades are probably monitored by not just the security regulators, but also bank regulators. So as a result, their trading are under heavier scrutiny. So our guess is even for accelerated insider trading reporting, the coordination may not necessarily work because the OPEC example, there is nobody monitoring OPEC saying that you should not let your members to reduce producing of oil. But here, there is, in terms of financial firms, regulators are constantly monitoring them about that. So those are the questions that I've got. Those are very good questions. And that's the end of this LinkedIn Live. Thank you very much for watching. In the next LinkedIn Live, we have Alex Belloni talking about how firms use artificial intelligence to better monitor the results of their decisions. Thank you very much for watching and see you at LinkedIn next time.